John, what's going on?
Good morning, Pete. Happy Saturday, everybody.
I am ready to go. I'm just starting my second cup, so about 20 minutes from now, I should be talking like Mickey Mouse.
I'm on number 3 already, so I got you beat.
Wow. Wow. All right. Alan, just to give you a heads up on that, past Saturdays are not posted on the website. They are emailed out. We don't keep a track. We don't have a place specific to posting Saturday sessions, but every Saturday session is the same link if you want to watch the replay. So any meeting that you were invited to, just click that same link. And we typically keep those links for roughly a month out there. So anyone that you have been invited to, you do have the link for the past. Okay. All right. So, John, I think big thing. I want to start out with the context of just looking at the S&P 500. We'll just throw this up on the screen really quick.
Yes.
And it felt like the market had a monster bullish week, mostly because of the recency of what happened on Friday, the big move to the upside. But that does not look to me like we had a great week. How do you feel about that?
Not at all. All I see is a bright big Apple and Tesla and Qualcomm and Amazon. And utilities was up 3%. So if you just ignore what happened yesterday and someone came up to you and said, hey, this week, guess what? Utilities was up 3%. And, Apple and Amazon and Tesla and Qualcomm, brought technology and communications. Consumer up 1%. That doesn't sound too exciting to me. So to me, we had a very kind of lackluster week. Even if you look at the price action in Apple intraday when the news came out, it sold off all day. So look at that red candle. It gapped up and it just kind of sold off. Not pretty. And I think some institutions who piled into it back in February got a little buyer's remorse and sold off.
Yeah, here's the open up here. It was below the open the entire day.
Yeah, so that's not always that, that's not the greatest price action there. And it's kind of like if you were just listening to the headlines and you were listening to, if you just kind of looked at the sector percentages, you would say, oh, we had a pretty good week. It was okay, a little mixed, but pretty good in some sectors, but it really wasn't. And we're kind of right back to where we started from.
Yeah. Yeah, we spent an entire week and basically over 5 days, we ended up in the same place we started. And we can actually talk about, whether or not the reason that happened is good. We like to sometimes just focus on the stocks. And obviously, we're in the throes of probably what was the busiest earnings week for the entire earnings season. And obviously, for good reason, we're focusing on the earnings and some follow through on those stocks, which we can get into Carvana in a minute and a 38% move in one day, which, the big announcement was they finally decided to focus on profitability. Oh my gosh, why didn't anybody tell them that before?
Yeah, that's a short squeeze is what that was all about. And those are fun.
Yeah, we're also talking about the possibility that's got a huge short float. By the way, I don't know if everybody
30%.
See that. We talked about that. I believe on one of the coaching calls this week. The short float is almost 30 something.
It was 30, right?
29.6. It was actually 36 as of like a couple of months ago. So that has the potential to head in the other direction. One short squeeze that we were particularly talking about, which is a stock we mentioned probably about a month ago, is Boeing. This particular day right here after earnings, and the stock just kind of floating back to the upside. But really, this day is really where the shorts got squeezed.
Yeah.
Right there.
There's a little rumor out in the street about Boeing. Did you hear about that?
No.
Warren Buffett is the rumor was that Warren Buffett's looking at it.
Did he call you again?
Yeah, he called me up. He told me he was looking at it. But yeah, he there was a Bloomberg article, I think it was 2 days ago. They're talking about his cash hoard and what can he possibly buy to move the needle. And Boeing checks all the boxes. It has a moat, which he loves. It has it's a U.S. manufacturing based company. It's just the only checkbox that I guess it doesn't have is good management, obviously, because of what's been going on with quality control. So yeah, 2 out of 3 of the boxes for Warren Buffett's criteria are checked. And there's just been some rumors that, he might be looking at it.
Interesting. So let's actually talk about why the market rallied on Friday and whether or not it creates more questions or whether it gives some clarity on the big picture. So obviously, we spent some time. I know, John, this is a big thing for you and myself as well. We're right back at that 50-period moving average, which we could play the replay from last week, and that's exactly what we talked about. We opened up, and this was the first 3 days. So that 511 level, downtrend level, 50-period moving average level, kind of bore bearish fruit last week. FOMC did not really squash the market until the specter of what actually happened on Friday, which we can kind of dig into, which was basically the jobs numbers came in a little bit softer, which for those of you that aren't 100% clear on what that means, the Fed could not discuss lowering interest rates if the jobs and the economy remained hot. And that's kind of like where they were stuck in a corner, and the number came in softer than expected. And that kind of opened up the door. Clearly did not say they were planning to do it, but it definitely opened the door to the possibility of them saying, well, now we could lower rates. We could stick to that promise we made last year. And even if we do it once, everybody's going to be happier about that. So is that a good thing, the fact that things cooled off?
I don't know. Is it a good thing that when bad news is good news?
Exactly. Yeah, that's what I'm saying. So on the surface,
bad news is so bad news is back to being good news, and that means that we're hoping and praying for a cut, and that's never a good position for the markets to be in. And one of the things I do is I take a step back and I ask myself, well, who controls the market, right? Institutions control the market. It always goes back to institutions with me. So if they control the market and you were an institution and you were sitting on top of a cash hoard of billions of dollars to put to work, and this most recent corrective action, which it wasn't even a bear, it was just a corrective action, right? Was that enough excitement to put you back in the market? Was that enough fun and games for you to say, you know what, I'm going to go in at cheaper levels now and buy the market? To me, the answer is no. And the same thing on the downside. If I was a hedge fund and I was, let's say, a long short hedge fund where I could go in both directions, was this enough of a downtrend where I'm going to go short now? And the answer to that is also no. So to me, we're in nowheresville, and that's not a good place to be. It's not fun, because what happens is the most likely outcome is we chop around a little bit until we figure out a direction. And
we actually did put on a short this week after the market kind of rolled over a little bit, and that short didn't follow through. We were looking for this move after the first 3 days of the week, and I'm like, yeah, this is great. The market's tanking, doing exactly what we thought, and it didn't break through support, so we ended up taking a small loss. So I agree with you. The short does not have enough foundation under it to lean into it at all yet.
Unfortunately not. I was also pretty short going into the week. I held on to my shorts from the prior week. I had to let go of some of them. Now I'm a little bit more balanced. I'm going into this week a little more 50-50. I was a little more bearish going in last week. And now I'm just lightening up, not adding anything new, and just kind of waiting to see. We're nowheresville, and nowheresville is no fun. You have to kind of wait. Yet you don't have, it's kind of like being on a sailboat and there's no wind. Like you don't know which direction we're going to go in yet. So, like you said, there's going to be specific stories, and, I know we're at the end of earnings, but there might be one or two groups or sectors or areas where we can look. But as far as sizing and scaling and everything else, we have to kind of tone it down a little bit.
So I'm actually glad you said that, and everybody should know we did not plan that, because we've actually spent a considerable part of this week, starting with Monday morning's game plan meeting. Literally, I've been pounding the table on, this is not a moment to size up. This is not a moment, right? There's just too much. I don't want to say mediocrity as much as lack of clarity. I think it's probably a little bit better way to put that. And that for traders who are on top of their game, when you recognize that, you then have to take the right action with what kind of risk you're allowing yourself to take, what kind of profits you're expecting to make, and dial it down when there's less of a bias. And that's what good traders do.
Yeah. Like I always grade the market. We always talk about that, like A+, B+, and everything else. Right now I'm at a B-, which is basically kind of a neutral grade. But there's something that when you have a B- grade, it's a very quirky number, because it's either a B- with volatility, meaning like you're waiting for a move, right? Or you're expecting just nothing to happen. And that's kind of the camp I'm starting to get into, a more neutral, kind of choppy, up and down. Maybe we'll test the lows, we'll test the highs, we'll bounce around like a ping pong ball a little bit, and then something will happen, like a catalyst, some sort of news event. It could be the Fed, it could be geopolitical, it could be whatever, will break in one direction or another. And that'll be when I load up a little bit more and add size. In the meantime, from an options perspective, we have to get a little bit less aggressive on our bulls and bears, which means we do more spread trades, and then we do more butterflies. We do more sideways stuff. We add
actually, it's funny. I was just going to ask you that with the expectation of not getting followed through. How does that? I mean, time is obviously then against somebody buying options in this particular window.
That's right. It gets a little more challenging. So you have to, straight calls and puts. Like when the market ripped lower, you could throw on a very aggressive put option to try to catch that move. And then if you believe there was going to be a bounce, you could have quickly went in the other direction. Very hard to predict in time, but that's what you could have tried to do, especially with volatility picking up momentum on in your favor. But then when you have this kind of choppiness where volatility is starting to dry up a little bit, you kind of have to just do you still have to do theta positive stuff where you're waiting for the clock to kind of just melt away, even if volatility isn't that high. Because
explain theta positive, John, just for the people that are not.
Yeah, so theta basically means time, right? And one thing to understand about our world is that in the real universe, every time unit is the same. So there's 24 hours in a day, 7 days in a week, and so on and so forth. In options universe, theta is not linear. So theta drops off the face of the map after 30 days. So basically, if you're looking at a chart, after 30 days, theta gets very aggressively fast to the downside. So that means if you're in a trade, time is really your enemy that last month. If you buy a monthly option contract or something like that, theta is ticking away and eating away at your profits every single day, kind of like an ice cube melts in your hands. The way to offset that is to sell premium against it, where if you're a seller, you're receiving that theta, you're receiving that in the form of income, and that offsets the melting that you have on the other side. So it sounds complicated, but it's basically two legs you put together, or three legs you put together, where it doesn't hurt you, it helps you. That's the key.
Heading into next week now, kind of taking a look at the economic data for next week. Actually, first, let's actually recap this week before we start mapping out next week. So the Fed really, as expected, did nothing. And the market rallied instantly off of that. And it was mostly based on him giving a little bit of clarity. But then the 2:30 press conference started. He started talking again, and the market sold off hard and gave back all of that. And we kind of use that as a lesson for those of you that, I don't know if everybody saw what we posted or how that ended up unfolding on Wednesday. This move right here is what we're talking about. If that doesn't give you a clue into the uncertainty in the market right now, I'm not sure what would. Because that was basically reading headlines as they unfolded from 2 o'clock to 2:30 to 4 o'clock.
Yeah, that was definitely a crazy intraday move. And it just goes to show you that nobody really knows what's going on. Nobody really knows which direction they should place their money. They start to get bullish. Then the Fed kind of says what they have to say. And then even though it was fairly positive overall, it just went back down to where it was. And that's very indicative of a undecided, trendless market. And that's where we're at right now. And I always coin the phrase nowheresville. And that just goes to show you where, so it's just a matter of being patient. This might take a couple of weeks to play out. We could be talking about this next week. We might get a move this week. There might be something that happens, I don't think so, because it's a fairly quiet week, I think, ahead. But for the most part, we're looking at kind of much of the same, where we're just going to be range bound for a little bit.
So that's last week, right? Obviously, then the economic data came out, because I want to start working our way into next week and kind of road mapping it out. So obviously the non-farm payrolls came out Friday morning, and the market very quickly interpreted that as, okay, we softened up. It was less than what was expected. And also it wasn't exactly a mile less than what was expected. But the market quickly interpreted that as, okay, it wasn't hot. Therefore, the Fed is now opening the door to, they have the excuse to not lower interest rates kind of worked its way out of the system, at least for that morning. But does that have better long-term ramifications? Because then you get into the employment cost index actually went up. So
Yes.
jobs are going down, at least according to this. But then the employment cost index, which is how much it's costing companies to maintain those employees, actually went up. So jobs went down, hours worked went down, but the cost of keeping those people on went up, which is not good for anybody who understands basic math for a company.
And ISM went down. So, you have a mixed bag of nuts. And what happens is, what sometimes you don't see in some of this economic data, some of it's skewed, especially employment stuff. There are a lot of people that get double counted with some of this stuff because there's obviously people with part-time work, there's people with 2 and 3 jobs. Economic surveys, like when you look at they look at payroll data, that's one thing, so it kind of can double count sometimes. But when you look at home surveys, people have 2 and 3 jobs and they're struggling. So it's a mixed picture, you know what I mean? And another thing that I noticed, there was something on Bloomberg this week that shows institutional allocations. So in the month of April, institutions put $32 billion to work into equity ETFs. That sounds like a lot of money, but that's only 1/3 of what they put into the market the month prior.
Wow.
So if you ask yourself the question, what are institutions doing? And the answer is nothing.
So let's not let that get lost. I've been on top of this since Monday because this is a lesson that I did not know when I first started trading. Is there are certain periods of time, like we had for that 22-week rally, where it's like you couldn't make a mistake as long as you were long. We are not in that market anymore. If we are now in capital preservation, pick your spots, make some cash flow mode. And if you are frustrated right now because you're not getting the same follow through that you got 2 months ago, you are not paying attention and you're doing yourself a disservice. And I know that's a very strong statement, but sometimes we have to throw cold water on the frustration because we get questions and whatnot, and I'm frustrated. Why? Blah, blah, blah. And it's not the same market. We're in stop and go traffic right now. There's a rubbernecking delay. It is not, 7 o'clock in the morning. You're the only person and the sunrise is coming up. And you have to recognize that as a trader. You can't be frustrated. It is what it is right now.
Absolutely. And I mentioned 32 billion going into the markets with institutions this month in April. Just as a comparison, the period of time that you just referred to earlier in the year, the number was 120 billion.
Wow.
So that's the difference between what you just talked about and what's happening right now. People, meaning institutions, are just kind of hanging out. They're sitting on the sidelines, maybe buying treasuries, maybe holding cash, commercial paper, stuff like that. And they're waiting for a move. They're waiting to see, like I said, was this enough to get them excited? The last corrective action we had, the answer is no. And was the last bounce that we had this week, Thursday and Friday, is that enough to get them excited? The answer is probably still no. So it's just a matter of, my guess is, I don't like to predict the future, but I think based on what we see coming, this week, we'll talk about what's going on this week. I think we'll get much of the same, unfortunately.
I agree. Actually, a quick question here from Janae. If anybody has any other stocks, obviously it's a game plan meeting. Anything you want to talk about, you can throw that in there. We'll kind of keep it open today. Moderna obviously had a monster gap. We called it in the morning prior to the follow through. We actually had it as one of the stocks that we were planning to trade. We had this big breakout level that we were game planning for. We were not in the position, but we did have this breakout. We kind of mapped this out, traded into an inside day on Friday. For me personally, and then John can obviously give his opinion on it. It's only one day. It's one awesome day. It was up roughly 16, 17%, I think, on that one particular day. Yep. But it's only one day. So for my purposes, it's got one day of stacked order flow after not being able to get through that level for a while. So I'd like to see a little bit more. I'd like to see it stay there before I put a bigger grade on it. I like the long. Obviously, we had it in our list. Traded into an inside candle on Friday. But for me, it's one day.
Yeah, go to the weekly chart, Pete. I want to show you something. Okay, so look at if you just go to so you see the price action obviously from Thursday. That was Thursday, I think, right?
Yeah.
So if you look back in when was it here? It looks like June, really from June, July of last year. You see, it was kind of flat.
Yeah.
So that shows right there where you have that kind of like sideways, it's not really going anywhere kind of thing. That shows that institutions were kind of piling in at that point and buying. It shows that they were very disciplined in their approach, very disciplined in their price action there. And then it kind of fell apart. You'll notice that like people, and that's not institutions selling off and giving up. That's probably they would just finish with their order and they weren't holding the price up anymore, right? And that could happen. So what happens in a situation like that, obviously it fell apart after that, right? And then it went all the way down and made those new lows. When it gets back to that area of that stagnation, even though it was a year ago, whatever it was, a year and a half ago, that's all buyer's remorse right there. You know what I mean? So those people, those institutions that bought there are gonna probably test that level. And it might put some pressure on the stock unless there's a catalyst, unless there's news and they're willing to hold on to the name, and see where it goes. But just from pure price action perspective, when you see that basing from so long ago, that's a little bit to me of a little bit of a red flag where you have to kind of be aware that there's this prior support there.
All right. So thank you for that, Janae. Appreciate that. Again, if anybody has anything else you want to pop in there, absolutely. So we kind of hop into next week of there's not really a lot, which is actually good for trading.
Yeah, there's not going to be too many surprises, especially since we're now past earnings as well. We might get a little bit of a direction signal because of that. We'll see who piles in and what the volumes look like. I think volumes will be kind of important to see how much flow comes in. And right now it looks pretty tepid, just based on what I saw, those April numbers that I mentioned. We'll see if that follows into May.
So if we're mapping this out right now and I'm on my trading desk, I'll be like, okay, we have earnings to trade around this week, but other than the 10-year note on Wednesday, initial jobless claims, okay, that's important. But I would say we have a pretty open week of trading without having a black cloud coming up. The Fed's out of the way. We got jobs numbers came out. I think this, for me personally, if I found some ideas that were trading above average volume and didn't have earnings coming out within the next 3 to 4 days, those are the ideas that I'd be a little bit more aggressive on and heading into this week with that mindset where I'd be much more specific on. I know the bigger picture is a little bit less clear right now, although the SPY is obviously going to test the 50-period moving average on Monday again, which we kind of mapped that out again. So that's obviously a big level building an if-then scenario in that window. But I would be telling everybody on my floor, there's not a lot in the way right now other than any stocks that might have earnings coming up. And I'd be filtering all of my stocks by they need to at least be doing relative volume, if not higher than relative volume. And then I'd be trading specifically those stocks a little more aggressively.
Yeah, from a day trading perspective, yes, I think because you don't have too many things happening this week, single stock specific ideas would be the way to go this week from a shorter term perspective, and even overnight, because you could probably feel a little safer, for lack of better words, holding on a little bit overnight because there's nothing crazy happening that we know of anyway. All the known knowns are there. You know what I mean? So you could hold overnight positions with a little bit of comfort, knowing that you don't have a Fed meeting the next day, you don't have earnings out of Apple the next day, you don't have all this stuff going on. So you can hold things a little bit, maybe overnight, for an overnight swing type situation. But from a swing trading perspective, obviously we have to wait for a clear-cut direction.
So I think that'd be a little bit more sector specific here, because with the market being less than obvious, and we just took a look at that picture of the S&P 500. This is one of the scans that I run at night. And this is the last 5 days of performance of stocks that meet minimum criteria for volume and that kind of stuff. Healthcare perked up quite a bit over the last week or so. I know Lilly actually bounced, but then sold off. I think it bounced $70 and then sold off 60, something along those lines. But healthcare keeps popping up into my list of stocks that have some opportunity compared to a lot of the other ones. I know technology bounced a little bit, but I mean, Apple had a good announcement, but it's still bearish.
Yeah, I think a lot of these, unfortunately, a lot of these sectors, because they bounced and they went down, then went back up. They're a lot of the sectors are in nowheresville too, which is not good. But yeah, you have to kind of weed through that and just look at relative strength throughout the week. You know, what kind of made it up to the 50-day and held it. You know, what has maybe come off the bottom very strong, right? So there are some things out there. I know this might be the sleepiest of ideas, but utilities is very strong. So
Yeah.
I think if I'm going to look for bullish trades, I'm going to look there. Healthcare, I think, is another good area, like you mentioned, and that might be about it. That there might be one or two story stocks here and there, depending on what the week unfolds and earnings and stuff like that. But other than that, there's been a lot of kind of choppiness. Financials were a little bit of a letdown, I think. There were a couple of others that, consumer, with the exception of like Amazon, obviously, and other stuff like that, it's just been really, really tough. I think industrials would also be maybe a place I would look as well. I think the Dow kind of outperformed a bit as well. So I would look there on the bullish side as well. So maybe industrials, a little bit of healthcare, one or two tech names if you could find them, and utilities. That would be the mix, I think, for any bullish. But again, I wouldn't expect, going back to this, I wouldn't expect much out of them. So from an option standpoint, I would develop strategies that are a little bit more conservative.
So one thing I will say, and there's always the conversation we have, especially new members coming into the community. I don't have time to do the extra work. I don't have time. Well, you need to find the time in the current market conditions right now. You need to spend an extra 5, 10, 15 minutes before you're just putting trades on, because we're not getting the absolute follow through to the upside, which means you need to really think about what stocks you're putting on. And if you're choosing something, whether it's from the list I put in there or find your own, you got to really have some good reasons. And actually, I think Tim's on the call right now. Tim Haley, when we went over his idea yesterday in the game plan meeting, I don't remember what stock it was, but there was 6 different reasons why he was looking at the idea.
That's
great.
What
you need to do right now. You can't just be looking at something right now and saying it went up yesterday, I'm going to buy it.
No, that's building an edge. I talk about building an edge all the time. What is your justification for getting into this name? And it could be technical, it could be fundamental, it could be a combination of whatever. That could be a catalyst of some kind. But yeah, having an edge is what is going to help you differentiate between any old stock that you're used to trading and the right one. You know what I mean? And that's the key. You have to do the work. I mean, if you don't have the time, you have time to brush your teeth in the morning before you go outside. There's certain things you do in the morning that require you to do. And this is one of those things where if you're pressing buttons and you're placing orders, you need to do the work ahead of time. You just got to get up a little earlier, find time in your daily routine to make it that important.
So now, actually, obviously, a big part of what we do, we both lean on the market. We're kind of going up a little bit more for reasons to lean on it. And we just talked about it. And I can tell you from writing the newsletter every day, it's been hard to find A+ ideas right now. So you really have to lean on sectors and maybe even industry group specific stuff. And I just want to point out one that we've kind of been talking about for a while that actually did report some good earnings, which is showing relative strength to the rest of the industry group. First Solar was not going down when the market was getting pounded. It was not going down when the other companies in the industry group were, and the stock popped out. And it's going to be on my list for next week.
Yeah, that was really nice basing before it popped. And I think based on the price action prior, as you can see, it's up at resistance where you look at that previous area where it rolled over. If you'll go all the way back to whenever that was, yeah, right, that little, you just got to make sure it gets past there for a couple of days. And yeah, definitely a great opportunity after that because the coast is kind of clear after that. But yeah, those are the kind of specific names you got to really kind of dig and find and go through your filters, go through your screening, and just try to find them. It takes a little bit of extra time, but it's worth it.
So energy, which was the easier quote unquote trade for a while there just kind of fell out of bed after it
Yes.
made a lower high there, and all the bullish mojo that was in energy is pretty much gone at the moment.
Yeah, energy is right at the 50-day. It's definitely looking like, it put in a lower high before it hit the 50-day. So yeah, if you look at either oil or XLE, it's very similar chart. I'm looking at XLE right now, but it looks almost identical to what you have on the screen right there.
Well, crude actually got below the 50. We're looking to see if the XLE can hang on here.
So you got that lower shadow. So I mean, again, it's in a confirmed downtrend. I want to be clear about that. Oil, energy is now, to me, bearish in the sense that even though it's not below the 50-day, it's in a downtrend. You have clear higher, lower highs, right? And then you have a lower low. So you have three very distinct segments there. You have a high, a low, you have a lower high, and a lower low. And those three, if you add all that together, that's what you have right there is a downtrend. So what I would do is I would probably short into any bounce that you would see, and maybe even watch it then to break that 50-day moving average.
There was one group of stocks that we were paying attention to for a while: oil and gas, E&P, and the strongest sector, the strongest industry group within that sector also rolled over. So I think that the underlying strength here that was propping up the entire sector has gone. So a very different perspective here. Same thing with basic materials. Basic materials were strong. Even gold started to roll over a little bit. Again, the headline index, when you start to see the headlines literally everywhere, that typically is the top. And that's actually what ended up happening.
Yeah, XLB I'm looking at right now, you have a crisscross now of the 20 and the 50, which is obviously pretty, a bearish indication. And it looks like it's right up at that area where it could, where it's going to test and maybe start to go lower. So yeah, some of these sectors look very bearish now, or a lot more bearish than they looked a couple of weeks ago. So there's been a little bit, even though we've had kind of like a little bit of a ping pong ball bounce off the bottom and things felt great on Thursday and Friday, I think if you look at the last 2 weeks as a general summation, I think we had more sector deterioration than positive. So I think that's something to be aware of also. The internals are starting to look a little bit softer. And that's, that over the long term, that spells a little bearish for stocks. So we'll see if that plays out.
So let's talk about this as if we were on a trading floor now, John. Let's say you and I are standing at the front of the room. It's Monday. We're mapping out this month, for example, and we just looked at a lot of the major sectors. And let's just also call the SPY in that conversation. We pulled back from all-time highs. Now, as a trader, I'd always start the conversation in my office. I would say, what would we need to see in order for us to hit new all-time highs again? Like that's a big part of the conversation I would have. I mean, I go around the room and I tell everybody, give me the reasons you believe right now with the current climate, macroeconomic, earnings coming out, all that stuff combined, why do you think we're going to head back to all-time highs, and how is that going to affect how you're going to allocate capital?
Yeah, and you really got to scratch your head and come up with a good idea.
Exactly.
So
exactly.
The only thing I could think of is rates, and more rates. You know what I mean? If the data comes out, a little bit, especially the employment stuff. The employment stuff, I think, is going to be the manufacturing too, I guess. But if these payroll numbers continue to soften, that September lowering will be more and more of a higher probability outcome, and that could send markets higher. I don't know if that's enough to make it new highs, though. I think you'd have to have some pretty spectacular stuff to maybe make new highs. Perhaps, undertones, maybe a little bit of a truce geopolitically, that could help too. Those would be the two main catalysts that are out there right now. And that would be it. I think since earnings are past us now, for the most part, I don't anticipate big numbers out of like some of the retail earnings that come later. I don't anticipate any of them making markets move so much higher. You know what I mean?
Well, that's a big thing that I've been noticing when I've been doing the nightly research as well is, you're looking at the stocks that are making new highs are not the stocks that carry the entire market higher.
Yes.
Like NVIDIA is not making new highs. AMD is not even close to making new highs. SMCI is actually breaking down as well. So we have to be asking, where is the leadership for the same reason that the market rallied for the 6 months prior to this. And yeah, these other stocks are rallying, but is it like Carvana? Is Carvana carrying the market higher? No.
No, exactly. So if rates were to go lower, if there was enough inflationary data that came out positive where that 2% target looked more realistic, on top of the fact that employment doesn't get out of control, it gets a little bit, what the Fed will never admit this, but what they want to see is unemployment and payrolls to not be that great, but they don't want to see them fall apart either. You know what I mean? Because that's bad too. So they want to see growth maintained. They don't want growth to be too hot. So you want like a 2 to 3% GDP. And you also want to see a 2% inflation. You want a Goldilocks kind of situation. And if we get the Goldilocks, you will get new highs. If you don't get the Goldilocks, you're not going to get new highs. That's kind of it. It's hard. That soft landing is a very difficult thing to do and to time. So it could happen in September. It could happen year end. A lot of analysts are predicting another 10% if that happens. And that's what I'm hearing. But that's, it's not a low probability outcome. It's kind of like about a 40% probability right now. So I think it could happen, but we have to wait. And unfortunately, we're going to get a little bit of choppy in the meantime. And it's going to be stock specific, like you said. It's going to be sector specific from time to time.
So obviously here we talked about this heading into the week as well. The 10-year came down. So obviously interest rates on the 10-year note are coming down, which money can see that and start shifting into equities, a little bit of what we had on Friday as well. The VIX continuing to go down. It almost melted all the way back down. It's back in the 13 area again.
That's very encouraging, actually. That's actually the most encouraging thing I saw this week, a meltdown of the VIX. If we see it break that support level from, when was that, a couple months ago there, it's, that would be a really good outcome, how it kind of melted down so fast. The other thing to watch is obviously treasuries, which we just mentioned, like anything you want to see that 2-year, obviously well below 5%. It would be great if the yield curve got normal again. That hasn't happened in a while. That would be another positive indication of a soft landing.
One of the longest inverted yield curves we've had in, I think, 25 or 30 years.
Yeah. So if that normalizes anytime soon and durations actually do what they're supposed to do, that will also be a good indication of a soft landing. I think what people are worried right now, one of the actually they started to mention not the R word, which is recession. They started to mention the S word.
Stagflation.
Yes, they started to mention that this week, all the talking heads. So stagflation, for all you guys who all these fancy words, it's basically really crummy growth, like moderate to like no growth, right? Combined with high inflation that's sticky. So you're just kind of stuck in the mud, which is why it's called stagflation. And that's what people are worried about. I think that's becoming an increasing fear. And that's what's causing the markets to kind of chop around too.
All right. So I hope everybody's really internalizing this. We're really emphasizing the fact that right now is not the time to size up or have bigger expectations until we get a little bit better directional volatility in either the big picture or, quite frankly, if an individual sector picks a direction, we could trade the heck out of that. And who cares what the market's doing if we find a pocket of opportunity. So we're working our way one level up from the market. If the market breaks above the 50, the VIX keeps coming down. No bad news. Maybe we get a little bit, we could lean in a little bit more. But I'm absolutely more sector specific right now than anything else. In my mind, that argument that I would say on my trading floor, I'd be, tell me why you think we're going to make new all-time highs. Because we're basically saying, why do you think the market is going to carry the load where we could start? And it's a really hard argument to make right now, which means we have to look to other forms of trends, for lack of a better, other forms of order flow, which would be sector or industry group specific.
Yeah, I just painted a very iffy picture. Like, there's a lot of things that have to happen in order for that Goldilocks to happen. And right now it's not clear. So we're in the mud a little bit. Sector specific stuff is super important because one thing to keep in mind, here's the good news. Money has to go somewhere, right? It all goes back to money management institutions. They have a bunch of money, pension money, everything. If you're sitting there and you got to allocate capital, it's got to go somewhere. So if treasury yields start to decline, which they have been this week, and the VIX is starting to fall off a little bit, it gives me a little bit of a green light to put money to work, right? But I'm not excited about it because obviously we're not. So $32 billion did go into the market this month. But one of the things you have to realize, well, if rates are going to, if September is now back in the picture, then maybe small caps might catch a bid. You know what I mean? Because small caps suffer from from a high interest rate environment. So if that December number gets moved to a September number now, maybe small caps are something to look at in the future. And as you can see, it perked up a little bit. So if you look, that's actually a little bit of an early stage uptrend. You have a really lower low there, and then you have a slightly higher low, and then it kind of gapped up on Friday. So, that's something to keep an eye on. Maybe they'll try to make, I don't know if it's going to make new highs. That's a little wishful thinking, but that might be somewhere to kind of take a look at if the whole rate story becomes somewhat positive again.
So we had basic materials that were in quote unquote easier trade, or definitely obvious directional trade. That has changed pretty dramatically. I guess there's still a case out on whether or not gold and copper are going to maintain that uptrend. Obviously, energy has cooled off dramatically. You can actually say right now crude oil is actually in a downtrend. It actually pushed below the 50 and then pushed down again. So crude oil is heading down. How would financials be reacting to this right now, where the possibility of a cut, which obviously the bigger interest rates is how their wider spreads are how they make money? Can we anticipate that maybe this bull run has kind of run its course a little bit?
Yeah, I think with the big banks like the JP Morgans that you have on the screen right there, they are pretty interest rate sensitive. Wells Fargo, JP Morgan, Citigroup, they're pretty interest rate sensitive in the sense that lower rates would overall, I think, would be a net benefit for them, because they do mortgages and they deal more with customers and stuff like that, give out loans to individuals and small businesses. So lower rates would improve their bottom line. However, brokerage houses and hedge funds and asset managers. So you have to kind of split financials into two camps almost. You know what I mean? If rates continue to stay higher and volatility continues to pick up, the brokerage houses and the exchanges like CME Group and stuff like that, they'll benefit from that. So that's kind of how you would split that up. I mean, that's generally speaking, but that would be how I would kind of position myself.
All right. So we also mentioned healthcare. Healthcare actually, to me, doing my research, healthcare, I've started to notice a lot more stocks in healthcare breaking out and making highs. Some of them are biotech, which can definitely be a little bit, I'll just use the word risky, because biotech, one headline and, the stock can fly in one direction or the other. Also, a lot of the biotechs are, there's the whole obesity drug thing that's kind of working its way through there. That's making a lot of those stocks fly, which are moving the percentages. Those headlines are changing every single day. But on a percentage basis, I've started to see, it's one thing for individual stocks to start moving, but on a percentage basis, I've started to see that number go up with the amount of healthcare stocks, not just the individual, kind of names that you might be actually seeing in here. Let me kind of point that out over here. So you can actually see we're starting to see a little bit of a trend going up. And I love to see these numbers when you start to see them just slowly like creeping higher. That's when I start to notice that when I'm writing the newsletter, I'm like, oh, that's interesting, where the numbers are starting to go up consistently while showing relative strength to the rest of the market.
One of the things I like to do when I look for healthcare opportunities, either bearish or bullish, is I'll take out biotech sometimes from my when I do the sort. Because like you said, it's a lot of times it could be news specific, or it could be that particular name. So if you're just looking to find, if you're just doing trend trading and you're looking to find a group or an outperforming stock that's in the sector that you're looking for, sometimes taking out those types of groups helps, because it could really skew the numbers a little bit. You know what I mean? But I definitely noticed a little bit of, there's definitely more healthcare names that are starting to perk up a little bit. And that would be an area that I would look for some bullish exposure this week.
So this, when I run these scans, these are the minimum criteria are 500,000 shares per day, average to range of 50 cents. So it's a decent amount of stocks, but liquid enough to matter, but not necessarily too illiquid where one stock that might go from 5 to 50 in 4 days, that kind of thing.
Yep.
So if we start to dive a little bit deeper into healthcare, we do have some of them that have broke out and paused. Just to give everybody a list here, if you want to take a snapshot. Some of them are at or near breakouts, which is kind of cool. I love to see that. And it's a decent sized list. Obviously, we talked about this ALPN. I know Ronald asked about that on the day that it gapped up and pretty much gone sideways since that merger talk started happening. I think the interesting part here, John, and I don't think it can be understated. And I know I keep bringing it up, but if we're having a hard time finding ideas, that has to be a clue of tempering your expectations, not only for what you can be expecting to make it right now, but also making smart decisions about how much you're allowing yourself to risk.
Right.
And I've been very clear about this with everybody in the community based on how I've been seeing things over the last month. I've been clear about reducing exposure, and you could take a few losses. They don't matter though. If you take a few losses on reduced position size, who gives a rat's patootie about what your win-loss percentage is if 4 trades equal what you might risk on one good market condition? It doesn't make a difference. Yeah,
I've been sized down. Like I said, I kept my shorts and they hurt me this week. So but I wasn't really big on them. I had maybe I took some stuff off, and it's part of this game. You know what I mean? You have to kind of from a swing trading perspective, you're always looking to have an optimal basket, right? Your optimal basket is going to be bullish and bearish. You're going to have some ideas, both bullish and bearish. And you have to kind of always, it's like a living, breathing thing. You have to add and subtract based on what you see in front of you. But when what you see in front of you is a little murky, you have to just make your basket smaller. You know what I mean? And just kind of sit back and not expect too much out of your bulls or your bears.
So the VIX, obviously, I mean, you have mentioned several times in past calls where the VIX is will matter on whether you're putting on a credit spread or a debit spread. And obviously we pulled all the way back now where some premiums have fell off a cliff again, so to speak.
Yep. So with trading strategy right now, because we're sideways, this is where it gets tricky because VIX and premiums have compressed, but unfortunately you have to sit out there to make money. You have to kind of sit out there and kind of sit through maybe some choppiness. So it still makes sense to do some spreads because you want to be theta neutral or try to be theta positive, but you're not going to make any money on volatility most likely. So if you do find a specific stock that's a story stock for whatever reason, it's a specific name, a specific catalyst that's going on, straight calls or straight puts would be completely appropriate.
Well, let's use mRNA and Carvana as examples for the way, obviously people are talking about these two stocks right now.
Yeah. So if you look at, I'm going to pull up, like with mRNA, the problem with those two is that even though the volatility index is really low, those names historically have very high implied volatility. So let me just take a look at, I'm looking at I just want to take a quick look at Moderna's overall. Yes. So their implied volatility, was going out at 2 weeks to May 17th. Their implied volatility is 50%, which is pretty high considering, just for comparison's sake, if I take Moderna and then let's say, let me think of someone a little more boring, like UNH, let's say, like United Healthcare, right? If I just compare the two, United Healthcare's implied volatility right now is 18%.
Wow, 18 compared to 50.
Yeah, so if I'm going to trade Moderna, I would most likely do some sort of spread trade because I want to, I'm paying that excessive premium. You know what I mean? To buy a call option or to buy a put option. So I would probably look to find some sort of target and sell some premium against that core position to reduce the overall cost.
So if anybody has anything that they want to have us take a look at while we're on the call, you can start posting those in there now. We'll take a look at those. Obviously, this is probably a really good time to have group discussions around ideas just simply because of the way the market is right now. And I want to be super clear about this because, we all get excited about learning something. We all get excited about wanting to use it. And I know, John, you and I have both been teaching, educators in this industry for a long time. And, it's very, it's common. You're excited, you want to learn about it, you want to apply it, that kind of thing.
Human nature.
Yeah, and we completely get that, right? But right now we are more in be smart mode. We had 22 weeks of amazing, and now the market's just kind of digesting it, pulling over for gas. We're still trying to figure it out. Be smart. Pay attention. That doesn't mean not watch every day. Pay attention because things can change with one headline. But I just can't stress this enough. We're in PPC mode that we call in our community, preserve precious capital. It's really important. I'm going to tell you why, because it's a personal thing. That when I didn't know this early in my career, I would overtrade all the time. Like I was excited and I had buying power and the market was open and I just traded.
And you feel like you're doing your job. You feel like you're doing the right thing.
Market's open. I'm excited. I learned something. I have to trade because I'm a trader. And I didn't fully understand the amount of money I threw away simply because I was identifying as a trader who was supposed to trade because the market was open, because I learned how to trade, as opposed to I was an allocator of capital. And my job was to really determine what was the right allocation based on the likelihood of earning something on that. And right now we've discussed that the uncertainty has shot up dramatically, which if I would have known that early in my career would have meant so much more money because I didn't have to then dig out of a hole that I created for myself. And I just want to be clear about that to everybody.
Yeah, it's this is not the time right now to go stepping on the gas. That's for sure. You kind of just wait and see. Though there's opportunity, here and there, but that doesn't mean you sit and do nothing necessarily. But what you want to do is not just, if you feel like you're doing too much, or if you feel like you're just forcing things, that's a pretty good indication that you're doing too much. You know what I mean? Or you're just putting on trades with no edge. You're putting on things that just, I just want to have something out there. That's not a good edge. That's not a good reason. When we talk about building an edge, what you said, the person in the community, I forgot his name, he had 6 reasons. That's fantastic. To have 6 reasons to get into a stock, that's what you want, because that builds your edge. It increases your probability of being in the right direction. You know what I mean? And that's really what it is. If you flip a coin and you have a 50-50 chance, but if you add edge in there, and even if it gives you 5% over the year, a 55-60% winning percentage is pretty darn good. You know what I mean? Especially if you manage your downside correctly. So that's what you have to do. Build an edge, and if you don't have one, just don't do it.
Yeah, and I want to be clear. I'm not trading. I'm just reducing the amount of exposure. That's a very, very big difference. I'm finding trades every day. I'm finding stuff that match the edge. I'm finding stuff at the optimal entry. But the big picture is cloudy right now. So I'm just expecting less on follow through. Mm-hmm. And because of what I'm expecting to earn, I'm not risking as much. I want to be super clear. I'm not trading. I want to be clear about that.
Absolutely. And just on a side note, Carvana, 78% implied volatility. Wow. So these are the kind of numbers that, even though the volatility index is low, those are not good numbers to just go buy calls and puts. You know what I mean? You have to think in terms of, okay, what's my target on Carvana? If I'm going to be bullish on Carvana, if you notice, it's got a little bit of resistance up there, right? If you go all the way back a year and a half, whatever it is, that is where maybe I would do a diagonal spread. I would maybe say, well, if this week is choppy, here's where the market comes in. If this week is choppy, I don't think it's going to get past that line, right? Because the overall market's not going to take it there, right? So I would maybe go out if this is a several month strategy, if I think Carvana is going to crawl its way out of the doldrums, right? Because it had a nice pop, what I'm going to do is I'm going to go very far out with my option. I'm going to buy a call option, maybe September, you know what I mean? Maybe something really far out. And what I'll do is I'll sell monthly premium against it. So what I'll do is I'll that blue line that you drew, I'll sell premium at that level for maybe May or June. And then what I'll do is reevaluate the whole trade then, and maybe pick a higher level and roll my strikes up as the stock continues to make its way higher. That would be a strategy where I'm lowering my cost, I'm theta positive, and my overall core position, which is my original call option, is going higher. That would be the strategy I would look to do.
So I got a good question here by Monica. And there's 2 different ways. We're talking about the implied volatility of a stock versus the average true range of a stock. There's two different things. So I'll answer the average true range first part, John, if you want. She's asking how you can find the volatility. But in the way that we look at things on, to determine volatility of what the stock normally moves, obviously we're looking at the average true range. Now that's not necessarily the volatility in an option sense, but that's how much the stock moves from the low to the high on average at that particular moment. But implied volatility is a little different than that.
No, so what implied volatility measures is the implied move from a percentage standpoint a stock is expected to make in the next year. So, it basically gives you if you think in terms of a bell curve with the current price being the mean, the move is expected to go in that much of a direction on either side within a year, within one standard deviation. So you're thinking in terms of that's a big swing, 78%. So, that could mean a whole lot of pain or a whole lot of positive, right? So, but that's how the options are being priced, which are very, very, if you think about it, it's pretty unrealistic to be sitting here and saying, well, I think Carvana is going to be up 80% next year. That's pretty aggressive, but that's what the option market is pricing the option at. So that's basically saying there's a lot of back and forth that's going to happen between now and next year. And when you buy something like that, you're paying for it. So if you look at the money price of Carvana is currently trading at 121.67. So the 121 call options, which is right at the money, right? You have the right to buy Carvana at 121, it's trading at 167, right? Pretty much a break-even situation, right? The 121 call options for only 13 days out into the future are $8. So for you to even make any money whatsoever, by May 17th, Carvana has to go up to $129. You know what I mean? And that's a pretty tall order for a choppy market. So you got to kind of cut that cost off. You know what I mean? What you want to do is if you sell something against it, you'd be able to receive maybe a $2 or $3 premium by picking a higher target, and you'll be able to pay $5 instead of $8. That's a pretty big difference. That's $800 versus $500. You know what I mean? That's a 30% discount just by applying a spread trade as opposed to buying a straight call.
So I want to be number one. If that description or explanation that John just gave you want to go back to that part of the video, especially if you're more on the stock side of things, and that part of analyzing an option is new to you, go back and take notes on that part. John, where specifically? Obviously, we just looked at the call. Where can we find the volatility of? So you said it's 68% or 78%.
Well, any option chain will show that to you. So it's just part of any software package, you can add it to your table and it'll give you the implied volatility of that particular.
So you need to put it as a column in here?
You'd have to add it as a column. Yeah, it'll give you implied volatility. And that's an important gauge to have because it'll help you compare it to its peers, which I just did. I compared United Healthcare to Moderna, and I was able to say, hey, Moderna's a little crazy right now. And you could compare it to the overall market, the S&P, like SPY, I think is 19% or something like that. So, it kind of gives you a gauge of how volatile that stock is compared to its group, its peers, and everything else. It's a really.
I know a few years ago, there was a very popular option strategy that basically when implied volatility went below 10%, and it had a big volume day, something along those lines, with the implied volatility be all the way scrunched down below 10%, and then a big volume day with a big candle was kind of like an igniting thing. I don't know if it still works, but I know that was a very popular strategy back then.
Volatility strategies, they work pretty well, but what you have to do is really try to find extremes. And I always prefer. Obviously, most people have a long bias, but when I'm going to do any volatility trade, I'd much rather have a short bias, and I'll tell you why. Because time is on your side, right? If you short volatility and it starts to melt away, which volatility usually does, tends to spike and kind of melt down, right? You're also making money from a theta perspective. So you have theta deteriorating if you're short, right? And you're getting that money every day. And you're getting volatility deteriorating every day, which you're also receiving because you're short volatility. So you're stepping on the gas pedal twice. So I prefer to be, going long volatility is tricky. Unless it's 10%. 10% is great. If it's that low, then yes. you should probably go long volatility. But you don't have time on your side. Then you might have to sit in that trade for a little while until there is a catalyst, like you said, a candle or some sort of pop or something like that.
So the rookie trader who might not know options well, it might sound like you just described selling naked options.
No, what you want to do is always have protection. So when I say short, I don't mean just sell a naked option.
I just want to be clear to everybody.
Yes,
I don't want to take anything for granted.
So if I'm going to short the VIX, I'm going to have something on top of it to protect myself from a spike. So if the VIX hits 20, let's say, right? And I think it's a short-term situation. Like, it's not like a pandemic or something like that. It's like, I think it's just a hiccup. Maybe there was a bad piece of economic data that came out.
Well,
as you can see,
happened actually.
Yeah, like that's a classic example. If you're fast enough and you would have short the VIX up at that level, yeah, you could have made some money, but you have to be very careful that it does not spike to 40, because you could lose a lot of money doing that. So what you would do is a simple protection measure is to just buy an out of the money call option on top and then weigh your risk reward. Your risk is obviously would be in between the strikes minus the premium you receive. So if you do a $5 strike differential and you receive a $3 premium, your risk is $2. You know what I mean? And that's how you kind of figure it out, if it makes sense.
Just want to make sure that everybody we
don't like being naked. Naked puts are okay, but that's cash secured puts. That's a little bit different. That's if you are happy to receive the shares at a lower level. That's a great way to accumulate wealth over time. If you're building a portfolio, that
you really have to like the stock down at that level.
And you don't want to be too premium happy. What I tell my brother's a classic example. He's trying to build a portfolio for his IRA, and I'm telling him to sell puts, naked puts, because he has cash secured puts. But I'm like, don't get premium happy. Don't sell a put that you're not happy owning 100 shares or something. You know what I mean? Make sure you're willing and able to receive those shares and be happy. And that's the key with that stuff. Otherwise, it could be dangerous.
Okay, so big theme for today, or for this week that just finished and heading into next week. Obviously, a lot less clarity than we've had for a while. So me personally, and I've been saying this every day, is I'm still trading actively. I'm just reducing my exposure. I just want to be super clear about that. Maybe it changes this week. There's not a lot of economic data that could get in the way this week. We'll see. Maybe Jerome Powell has a bigger briefcase, and that means that it's the paperwork for interest rate cuts. Who knows?
It's funny. I remember Greenspan used to walk in with his tan briefcase. Do you remember that story?
Yeah.
So this is how old we are. So basically, if Greenspan, the former chairman from years ago, the traders used to look at the size of his briefcase, and if he had a big fat briefcase, that means he was trying to justify raising rates. So that meant that we were going to raise rates, and so traders look at this guy's briefcase to see what direction the markets were going to go in.
The briefcase indicator.
Yes, I remember that.
Ed's got a good point here about, for what we're talking about with GME. For example, back when GME shorting way out of the money calls naked at a premium of 325 wind up at 18 plus. Yeah, that's the downside.
Yeah, I mean, that's you got to be comfortable owning, and GME is such a speculative name, and it was all over the place back in the day, right? Do you really want to own that thing? I mean, you have to kind of always ask yourself what you want to do. And the market makers do not make it easy. Back in the day when GME was all over the place, the spreads were so wide, the break even was like $20 higher or lower in either direction. So it was like, okay, am I going to really speculate and risk $2,000 on one trade? So you had to really, they don't make it easy for you. If there's a real crazy thing going on in the market, the options market will react to that, and you'll have to pay up for that type of speculation.
Also, they're also self-correcting at blinding speeds now compared to when there was just physical options market makers adjusting the price.
Yep.
Which could, that could take a while for that thing to get back into where those inefficiencies took a lot more time to get back. Now that the prices are adjusting automatically with algorithms.
That's for sure. And the algorithms will always, they'll widen and lower the spreads based on immediate supply and demand. So you'll definitely pay up for a speculative type of situation, because everybody has the same idea as you. You know what I mean? And they're not going to make it easy for you to make a large profit so fast.
Which is why, for those who don't know, that's the whole point of pricing the options premiums, because they're selling them and they're protecting themselves based on what's expected.
Yep, and they'll flatten themselves out. They're being delta neutral, and they're on the other side, you know, making themselves even on their book, but they're making the spread in the meantime. They make money either way, so the house always wins.
Yep. So, John, I'm actually going to pull up one idea that I like heading into next week. If you have, let me know if there's anything. I'll pop in.
Yep.
There's a couple of them actually. I like 3M after breaking out and pausing. Some pretty good news prior to that. Nice base here, relative strength. A couple of bullish gaps in here. Did not rally with the market on Friday, but I still like the relative strength in the stock.
Yeah, no, it's a nice high tight base after a nice rally.
Yeah, I like that. And, you know, we were just talking about financials a little bit. AXP pulled back a little bit, but the uptrend is still pretty solid in place.
I have a long position on that. Yeah, I'm holding on to that one.
Well, sometimes when this doesn't get followed through on the next pause, that could end up being like the last step to glory here, but we'll see. It hasn't gotten back to that level again. It's kind of hovering right at the support level. So that's kind of really what I'm watching this week to see if it holds that level.
Yep. And this is where sizing comes in, because I had to sit through that pullback this week. You know what I mean? And that to me, I had a small enough position where I'm okay with that. If you're sizing up too much, then that sideways to kind of slowly drift lower that AXP experienced this week might be enough to shake you out of a trade like that. So you have to kind of really, position sizing could also help from a psychological standpoint, like we talked about. You know, I'm looking at also industrials AER, little obscure there, but that's looking pretty good. It looks like it wants to get above that resistance area. We'll see. But again, if it kind of creeps sideways, I might do a calendar spread or some sort of diagonal on that. Again, not straight calls, because it might just kind of sit there all week, you know? And then on the, let's see, boring stuff here, utilities, ATO.
Like the
ATO made new highs, so kind of missed the memo, you know, that the market's going choppy to sideways. And then let's see, on the short side, I'm looking. Oh, actually, no, wait. I got check out Texas Instruments, TXN. That one also high tight base, similar to what you just showed, and then also General Dynamics, also industrial, defensive, aerospace, kind of just basing sideways. So again, that might be, if the markets turn a little bullish, that might try to, you know, make a new high or get near that high. Again, not expecting a lot, you know what I mean? Just kind of expecting maybe to drift a little higher, maybe do some sort of spread trade there too. On the short side, let's see. So I know we were talking about healthcare being positive, but I actually have a negative one here, EXAS. That one did a beautiful bear rally right there. You see, look at that, look at it bouncing there. And it from a swing perspective, again, I need confirmation on this. I need to make sure that it starts to roll back over again. So we'll see it, but it had a really kind of ugly candle on Friday after that gap up. So I'd like to see how it performs the next couple of days. And if it starts to roll back over, maybe I'll get short on something like that. And Microsoft on the short side. See, sometimes the popular stuff does show up on my screener. Again, a nice gap on a Friday, but it could be a bear rally, which means it might run out of steam. Not something I'm going to jump into on Monday, but something I'm watching to see how it performs in the next couple of days.
Did you read any of the news on Starbucks? I kind of feel like this short, it's kind of like right on the precipice here. There's a lot of room to go. I mean, they had a lot of bad guidance after they announced.
I think Starbucks is from a fundamental perspective, I think Starbucks is kind of tired. It's an older stock now. How many more ideas and 1,000-calorie drinks can they make up? You know what I mean? And I think there's a very health conscious generation coming up. The Gen Zers are even more health conscious than the millennials. So they're into that matcha and all that kind of weird stuff, the mushroom coffee. And there's lots of funky stuff out there that give you energy and that are healthier for you. And that whole latte and frappuccino generation are starting. It's getting tired. You know what I mean? So that's the story behind everything. You know what I mean? So Starbucks has to adapt or die, and that's the 5-year story. You know what I mean? So yeah, it could break down. It could break down if there continues to be selling pressure.
Yeah, there's a ton of room below that 70 level.
Flowserve is another one. FLS. That's another one. I think that was another one on the positive side that I was looking at. So I'm very heavy on industrials. I think it's not again, these charts don't look the greatest, but they look like they held up a lot better than the market. You know what I mean?
We've actually found ourselves looking at relative strength plays, even though they're not necessarily going higher. They didn't go down when the market got crushed either. So there was a bid under them. We were talking about RTX as one of them. And ETN, but RTX seems to be holding up a little bit better, but they're both in a box here.
Yeah, I mean, industrials are just showing some relative strength, and we have to kind of go with those if we're going to follow our strategy. And it was kind of funny how Microsoft showed up, but I mean, again, that's the kind of stock I like to avoid those name brands, because if that catches a bid, it could really rip. If there's like a news or an upgrade, or there's so much institutional ownership that you got to be careful on those name brands sometimes. You know what I mean? They could continue to outpace. So again, that's why it's a wait and see on the short side. I want to wait and see how the markets. Obviously, if the markets kind of drift lower, Microsoft will probably drift lower too.
Guy's asking about SMTC. We actually had an optimal entry in SMTC about 2 weeks ago. So it needs to pause. I know we had a little bit of a pause here, but I'd prefer to see it kind of go sideways a little bit more, of pulling back. It's obviously showing some good relative strength. And even if the gap fill is up here, which is another $6 high, which is a pretty decent percentage move for this price stock, but absolutely showing some good relative strength.
But here's the thing. If we were in a super, super, super bullish market right now, would you have said the same thing? You would have been a lot more bullish. You would have said, you would have been like, oh, you know what? Let's go for it, because the whole market's going to rip. And, sometimes the sentiment is what really makes you think, okay, let's wait for a pullback. Let's see how it does, right? Let's see if it sits sideways for a little while. That's where, putting it all together is so important,
Yep. So diving a little bit deeper into this is really getting into the weeds, but I call this reading the notes as opposed to just singing the song. So obviously we can see where it's been, and I'm looking for more of this than this, but kind of reading the notes is 1, 2, 3, 4 candles in a row that are melted candles. So the stock actually did end up going higher, but whether you call them dojis or whatever you want to call it, it's going higher, but 4 days where there wasn't an extreme in the stock, where it almost opened and closed in the same place. So that's why I'd be a little bit more inclined to be looking for a pullback to bid into like this, as opposed to where the stock really hasn't slowed down at all in the last 4 days. Even though it went higher, we didn't get this.
Yep.
Look at the difference between those candles and the move higher versus what we're seeing in the last 4. So it's absolutely bullish, but another reason I wouldn't have bigger size there. Exactly.
So it's all about putting it all together, and that's a really important concept.
Yep. So we need to do a little bit more of that right now. It's just we're not going to get paid by the hour right now. We're going to get paid for making good decisions, and we have to be completely okay with sometimes where we had an amazing November through, let's say, March, and things are just kind of cooling off right now, and we have to be okay with that. If we were in my family's deli back in the 80s, I'd say we'd be wiping the counters down right now, and that's it. We still have to pay the bills.
That's it. Sometimes we have to just sit tight, keep the dry powder, and wait for the right opportunity. So we'll see.
It's not the sexiest thing, but it's the right thing. We can still take opportunities. Got to let that picture clear up a little bit. So, John, as always, thank you for your time on a Saturday. I really appreciate it. Obviously, everybody who's here live really shows your dedication with the big cup of coffee with us and joining us for Saturday. You can hit that button again, the same exact link to watch the replay. We talked about a lot. We got into the weeds on a lot of stuff today, from risk to volatility to a whole bunch of things. So take some good notes. I'll do a summary for everybody later as well. I'll email that out. I'll do an outline and a summary for some of the key points. So look for that email as well. All right.
Yeah.
So have an awesome weekend, everybody. We will speak to you soon. John, any closing thoughts? Anything to leave with?
Yeah, I mean, I think we covered a lot, and I think it's important in weeks like this to really kind of map out how we think and what, how to approach the markets the right way. These are the kind of weeks that really kind of make or break you sometimes, because if you do too much, you could get hurt. So you just got to be careful.
Yep. I'll leave everybody with one of the quotes that I had from one of my very first mentors. His name was Joe Blasey, when I was trading out in Edgewater in New Jersey. And he said, if it's hard to find, it's not there.
Wow. Put that up on your wall right there.
That's a deep statement.
Yep.
So that's where we are right now.
That's a good one.
All right, everybody. Have an awesome weekend. We will speak to you soon.
All right. Have a good weekend, everybody.
Bye-bye.
Bye-bye.